Good evening and welcome to the Australian Stock Market Show, and tonight we'll share with you whether now is the time to give your cash to the bank or is it better for you to buy bank shares. On top of that, we've got plenty of stock opportunities to get into as we help you to make better, more informed decisions. Hello, I'm Janine Cox, your host for tonight, and joining me is Gillham, and we're Australia's most trusted stock market educators. Hello, how are you?
Oh, cool. I'm good.
That's good to hear.
I love it. We're sort of in our new studios, aren't we?
Well, look, I guess, yes, we are.
That's why I'm excited. I know yesterday I did my market wrap from in this room and said to everybody, we're in the right building, but we're just not in the right studio yet. Yeah. But we're getting there. But it's nice to have a home again after being... We were homeless for the last few months, so it's good to be here in our new studio. So not all set up properly, but I'm excited about where we're going.
Fantastic.
How about you?
Oh, well, look, I mean, I'm just really looking forward to the topic tonight because I love talking about banks, as you know.
Nothing else exciting happening in your life other than the topic on the banks?
No, actually, not at the moment.
Oh, God. So
Valentine's Day today, and we're both sitting here.
And we're both sitting here with our partners are sitting at home, yeah. But I did text my wife and tell her I loved her and everything else.
You're a good boy.
I just didn't buy a flower, so I'll be in trouble when I get home. But anyway, now Janine.
Yes.
I think we need to move on.
With all the talk in the media about mortgage defaults caused by this current rapid-fire increases in interest rates, my quote for tonight comes from Dan Quayle, which is bank failures are caused by depositors who don't deposit enough money to cover losses due to mismanagement. What are your thoughts on that?
What are my thoughts on that? I've been saying the banks are rapists in suits for so long it's not funny. So they've got to mismanage something, don't they?
The fat cats, they were called in the GFC.
Well, they were. I mean, you know, how do they... I mean, the thing is classic example, GFC, right? All the banks in the US got into trouble. Well, the big ones did. Some went bankrupt and the US government had to bail them out. Okay? Yet not one bank executive got charged, put in jail, whatever else, nothing. And all the wrongdoings they did are mismanagement. So that proves that that quote's 100% accurate. And we don't have the same issues to the same levels we do in Australia as we do.
So do you think we'll have a repeat of the GFC then?
In the US, absolutely, because they just keep doing what they do. They just instead of being subprime mortgages, they just package them under a different name and they'll be exactly the same thing, and they'll just repeat what they were doing. But it's not the same case in Australia. It's completely different, much more tied to regulations and everything else. But I still call them rapists in suits because they're really good at taking your money and not very good at giving much of it back to you.
Right.
So they're very much like that. But that's my opinion on the banks. But Janine, I know before we get into our first segment for tonight, that we need to let everybody know if you do have a question that is just dying to be answered, then all you need to do is simply text us on 0423 959 846. That's 043, sorry, I'll say that again, 0423, I'm left-handed so I get a bit dyslexic, Janine, 0423 959 846. So remember, pick up your phone right now and get texting your questions into the show, and Janine and I will get to answering them shortly.
Just let me give you the left-handed screwdriver. While we wait for your text, it is the second Tuesday in the month, and this means that we normally take a look at the Australian market sectors. But as we did cover that last week, we'll take a look at the All Ordinaries Index. So let's get into the charts.
Oh, so you don't want to say we made a mistake last week and got it backwards. Okay, so we're going to look at the All Ordinaries Index. Now, they know my opinion.
Yes. Now, what I thought I'd do is, I don't know if you've covered this before because, as you know, I don't watch you every week because I see enough of you. You can see here on the All Ordinaries Index the declines that happened over the past decade. Now, we saw back here in 2011 there was around about a 25% fall. We saw in 2015-16, that was the Royal Commission and everything that was going on with the banks at the time, around 20% decline on the All Ords. And then we had 15.5% in 2018, the end of 2018, it was in December that the market made its low. So I just thought it was interesting to have a look at those ranges and then just compare that to what we've seen in terms of the decline, the recent decline. Now, it's well within that sort of order. Anything that falls outside of that is typically a much bigger correction, which the timing on the market is not suggesting that that's likely to occur anytime soon. Now, if the market did take off below because in your market report you were suggesting the market could come back and test that low.
No, I didn't.
Did you? Not?
No.
7,000?
You should watch it then. Everybody else just said, no, Janine, you're wrong. He didn't say that.
Well, you said it would come back for a couple of weeks, didn't you?
Yeah, but not to that low.
Okay. Now, okay, that's great.
Don't panic, people.
So we better tell them the bad news and then the good news. That's how it works.
Well, I told them the good news. You can have the bad news tonight.
Okay, so given that the market's actually come up off that low and is testing that high there, it looks really promising, and the market is forming a really, what is usually a normal sort of a pattern. If we go back to what occurred after the low in 2011, we saw that sort of a testing of lows, and similar sort of thing that happened here in 2016. There were a lot of volatile movements off that low, and eventually it pushed off and continued to go higher. So we've seen that unfolding in more recent times, so your couple of weeks down on the market could be spot on before the market then takes off again. But I thought I would just quickly show another idea here, which is to mark this up altogether. And I'll just quickly go back to the chart. Now, I hope people can see this, but what I thought would be interesting to look at is before each of these major declines occurred, what was the run-up to them, to the peaks? So we saw around 55% rise from that low in 2011 to the high, okay? And from this low in 2016, what did we see? We saw 53%. Is this magic or what? That was to the high prior to the COVID correction. Now, admittedly, if we look at the small correction that occurred here, the rise was only around 35, 36%. So let's have a look at what we've got now, and we can see that if we put a few of these back on the chart again, we look at these two levels where the market is moving right now, we can see around 35% occurs close to that 9,000 mark, 8,900 say to 9,000, and then 50-odd% is around 10,000 points. So it's realistic to think that our market could trade to around 9,000 points. You know,
this year?
I'm not saying by the end of the year, it's possible. I would say that this is my medium-term target for our market at the moment, is that high up there. And going forward, I see no reason why our market can't trade to these nice round numbers down the track.
No, I don't see why I can't do that either. I just haven't gone that far out with everybody on my my market reps that I've been doing. So, you know, normally I'm giving the next couple of months.
Yeah, because if we have those sort of rugged bounces off the bottom, where we saw this happen before, eventually we get some momentum, but it was really slow through 2017, 2018 to get going. But you remember after these bounces off the low in 2011, 2012, we had a really nice rise, and there were some really good returns that could be made in that sort of move up.
And they were safe returns too.
Yeah.
They were really safe returns. What I love about this is that what people don't realise, or what they don't even think about, is obviously during all this time where you're seeing all of these big pullbacks that you've shown people, is during this time there was so much negative news on our marketplace. Crash, 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 crash. That's all we heard. And, you know, I was getting hammered on YouTube comments for people saying, the market is crashing now, you're wrong, you're wrong, you're wrong. And we were saying, no, the market's not going to crash. And it didn't crash in Australia. The only thing that crashed in the US was the NASDAQ and the S&P 500, technically. But can you remember what happened back in these and what the media was into 2011 and 2016?
Oh, there was so much emotion around that time with everything that was going on in the US and in Congress, and also when the tsunami hit. That really, there was so much negativity, that just compounded it at the time. But it wasn't long after, that was some months later, that the market bottomed and then just went sideways. But they were still pumping the negative.
Still pumping the negative.
But then the market didn't give up. It just sort of kept going sideways and then eventually took off again.
Yeah, so it's not what I'm saying is this is really normal what's been going on right now. So why should people be nervous about the market?
Yeah, because that's the point of what we're doing.
So I think what you've shown is really, really brilliant, and I think people should get excited about what you've shown. And I think people hang on words of like, well, you said the market's going down, so I just get out. And we went, well, no, we didn't say it was going down. We said it might be going down for a week or 2 weeks or might go down 5%. But we're not telling people to get out of the marketplace. It's more of looking things
just
in
let
this
the
bigger
market
picture.
tell us what's happening.
And all too often people don't look at this big picture over decades and go, okay, what is normal? And when they start to see it, they go, oh, it's not that bad at all. So I can ignore the media. Absolutely, you can. And ignore all the doomsayers, because generally, when you hear the most amount of noise, it's probably near the bottom. And it's within months of the bottom. And we've had numerous examples of that.
Now, one thing just to be mindful of is that when the market actually pulled back to test the low in 2016, it did take out some of these lows here. So that's why I'm saying what you were talking about before is the market could come back just for a couple of weeks and rocket off, but I'd be just watching this low here just to see what happens around that level if it does come back.
So go and watch my video from yesterday and you'll get fully informed of what I said.
Excellent. Good.
All right, I think we beat. That's all from the All Lords? Yep.
That is it for our thoughts on the Australian market.
All right, now just a reminder that if you are watching this live stream on talkingwealth.com, then you will see the expanded 75-minute show tonight. So stick your thumbs up for that one. Now, if you are on YouTube, you'll only see part of this live stream. However, you can still participate by emailing in a question to us. Now, we will endeavour to answer your question while streaming on YouTube, but if not, it will only be streamed on Talking Wealth in the second part of the show. So come and join us on talkingwealth.com for the full experience. Now, with the subscription at just $3.54 per week, that has to be a really, really great investment. Now, let's get into the first email question for the night.
Our first question is from Joe, and we also had a question for the same stock from Jim. Hi Dale and Janine, can you please take a look at ASX stock XRO? I've been watching the tech sector and particularly this stock over the past few months and waiting patiently. Maybe it is a little too early, but I would appreciate your analysis on this stock all the same. I've read your first book, Dale, and it's a great source of information. Much appreciation to you both, Joe. Thanks, Joe. Fantastic question. Great stock choice. So shall we have a look at the chart?
Yeah, we can have a look at the chart. I think
now, first of all, did you want to say anything about the fact that the tech side of things and when you're looking at these sort of stocks, what you're thinking about?
No.
No.
I'm going to talk about.
You're just going to cut it short.
Yeah, no. Well, I'm going to talk about the tech stuff in the.
Does the tech sector have to be going up in America for you to like these sort of stocks here?
It helps because you get the how do I say it? In the second part of this show, I'm going to be going into the tech sector, showing people on Talking Wealth. I'm going to be pulling it apart and showing them a few things, which I've been promising for a couple of weeks, but we're definitely doing it tonight because I said, Janine, we have to do it. So I'm going to do that tonight. But generally what you see is more, how do I say it, more inexperienced investors playing in the tech sector, and they see the tech sector in the US taking off and they go, Australia's going to do the same thing, and so they jump in on the tech sector in Australia, but it doesn't necessarily correlate that they should travel together. It's more of that, sheep.
It's the copycat thing.
Am I allowed
with
to
the fund
say
managers?
yeah, copycats, it's sheep.
Yeah.
And but there's been a lot more talk about Xero from people. I know we've had a lot more questions on Xero over the last month or two, because when it starts to move up, it's one of the biggest stocks in the tech sector, which people will see later on. But when it's starting to move, people like it. And because it's heavily fallen down since that big high through here, which is at 155. So it fell all the way down to 64. So it's more than halved in price. So if we look at this, where is it? That's the tool we want. So there's its all-time high way back there in 2020. And look at that, it's fallen 60%. So people are seeing this saying, oh, this is really, really cheap. It's going to go back up to $150, $160. Should I get into this stock? But is now the time to get into it? It's looking interesting. I do like it. I think it's looking interesting.
So if you hadn't already bought it now, would you be suggesting people watch it?
I would suggest some of our students have already bought it. I can guarantee that. And I think people who have done our courses would probably have already bought into this stock. Would somebody buy into this stock right now? I'd like to see, obviously we've had last week was a week that it closed lower. So far this red bar through here is just yesterday and today's data, so it's 2 days data, so that's a good sign. But I'd like to see this week finish and see where it happens, what happens, because if it just turns around and closes lower, then we might see a few weeks down. But look, I do like it. I think there could be a good opportunity here at the right time if it presents itself the right way in the next few weeks, but I do like it.
And we sometimes see some sectors rising while others are falling. It's not like everything has to move at once. So
No, correct.
we may be quite excited once we come around again to talking about the sectors next
Well,
month.
I do like the tech sector for this year, but I will say that with a bit of reservation in that there'll be specific stocks that I would like,
Okay.
not necessarily broadly across the tech sector, because I think some of them are going to struggle, especially ones in that payment systems, you know, the buy now, pay later, payment gateways, that sort of stuff, because there's a completely changed, the
Saturation.
landscape has changed that over the last 2 years.
Yes.
So I think that's going to, but other stocks, this is not in that landscape, but I think it's also going to have its competition, but I do like it.
Yep.
Anything you want to say?
So we like it. If people are looking at it, they need a good set of rules. And if you do, then, you know, a nice trailing stop loss underneath it as it goes up.
Cool.
So look, Dale, it looks like we've got a text from Daniel. Fantastic, Daniel. Great to have you with us tonight. Bought WBT at $2 due to strong support, letting it run. Now, how much does it have left in it? Oh, good question, Daniel. All right, so this is one's
shit.
taken off like a rocket.
Am I allowed to say that?
No.
I said stop.
This is a family-friendly show.
But we got rid of the swear jar, so that means I'm allowed to say.
No, it doesn't.
Okay. I'm not allowed to say that word, people. So I'll get yelled at. So did he say where he bought it?
Yeah, I think he said $2, I think. Where was that? Down there. It's right down.
Yeah. Wow, that's cowboyish.
Yeah.
God.
Okay, so he's bought it at some stage down near a low there, and it's just taken off like a rocket. See, this is a real quality. It's a quality issue, isn't it? Problem for somebody to have a stock go up 200%.
Why have you got a problem?
That's right, but it's about how do you manage it then, isn't it?
Well,
it's easy to get into it, but then
it's
you've got to manage
100%
it.
irrelevant about how far it's going to go. And that's what a lot of people don't understand. I'm not trying to be rude.
Does it have any legs left?
Who gives a crap?
Isn't it more like, hang on, what if it just tanks tomorrow?
Yeah, but who gives a crap how far it goes if you're in it? You just want it to keep going. So forget about how far it's going.
Yeah.
Just worry about what your exit strategy is.
But you say that, but then we teach people how to work out how far a stock's
We
likely to run
do,
to.
so that it's like having a signpost on a highway. You go, okay, I need to find exit 43.
Well, Daniel just wants a signpost.
Well, how do we give him a signpost without teaching him how to do the signpost? So, because he's just saying how far is it likely to go. I don't know. I'd have to spend ages on this, and even then it would be almost a guess.
Yeah.
It would be an educated guess, but it'd be almost a guess. But it wouldn't surprise me if it did start to fall away, because what you see, this sort of stuff, is when they get into these runs, you see more of the masses get in at the end, and it's when that exhaustion of the masses finishes, because the people buying this are probably more individual investors rather than institutions, and when they run out of money, it'll fall over.
I guess what we should be talking to him about is how does he need to think about this right now?
He needs to put an exit strategy.
It's more about the market could quickly take your money back, so it's to keep that sort of greed factor in check, and just to make sure that you've actually got that strategy. And like Dale said, a stop loss in place, a way to take some of your money off the table. Maybe you're wanting to take the initial capital off the table. I mean, would you just let it run?
Yeah, that's all I'd be doing.
Yeah.
Like I would be at the pub celebrating this at the moment.
I'd be looking for a way to take some money off the table. I'd be waiting to see how it unfolds.
You're more conservative than me. I would just be putting a stop loss underneath it. I wouldn't be getting out of it. I'd just be putting a stop loss underneath
Well, I mean, even on the daily chart, it hasn't taken out any prior lows yet, so
it looks
still
great.
not showing any
I think
weakness.
I don't know why he got into it, because I just think he's got more guts than I have to get into that. That's if he got down in at $2.
But the risk is it could just fall really quickly, in a couple of weeks and lose a lot of profit.
Have a stop loss. Let profits run, cut losses short. But I think well done at the moment. Make sure it stays a good trade by making sure you've got an exit strategy on the downside should it start to fall away. But Janine, we've got another text. This one is from Daryl. So if you want to bring up NMT, N for Nelly, M for Mary, T for Tom. Now, Daryl says, bought NMT in July 2021 at 55 cents. So if you can put that on the chart too, 55 cents. Sold it at $1.60 in April 2022. Now, he said, looking at a re-entry if it breaks 94 cents. Volume is starting to rise. Will avoid it if it drops below 75 cents. What are your thoughts? Interesting thoughts on that one. So you've put it
So
up.
he's come in somewhere around this level here, based on what you just
Well,
said.
I don't really care what he did in the past.
No, but I think it's not a matter about his entry. He's in it, like you say, but it's
no,
good
he's not in it. He's bought and sold. He's telling he's made money in the past.
Right.
And making money on a stock in the past is irrelevant to me. It's what are you doing right now? Because
I don't think it's completely irrelevant, right? Because we know that with trading, part of it is your psychological bank account and part of it is your financial bank account.
Yeah, but some people also
so
could also be giving him a false sense of confidence.
Well, that's right, and that's what he needs to be aware of. So that's really important. So it's about thinking, okay, I might be thinking that this stock is better than it is.
This is a new trade. It's a new trade.
Same as anything.
Same as any other just because I made money in the past doesn't mean shit to me, because it doesn't mean you did a good job back then. He might have done a brilliant job back then, but this is a completely new trade. So, and people often will make money out of a stock and fall in love with it and then keep trying to trade it, but the subsequent trade they lose because they keep thinking,
well, that's
I've
where
made a lot
doing
of
the
money out of this
analysis
stock.
that we do is really important because it actually shows you that, and that's what I love.
So what is it happening today?
Okay, so at the moment it's just got this little basing pattern which I think is actually really good. I'd like to see a bit of a rise up here. We all know that $1 is important, so if it trades strongly through $1, that could be the first thing to look at.
He said if it goes below 70-something cents, he forgets about it, which I don't understand.
Well, I think that's important because he's saying if it keeps falling away...
If it goes below that, I'd forget about it.
Well, so he's saying 70-something cents, right?
If it goes below that, I'd forget about it, actually, 79 cents.
Yeah, but we're back onto what he's saying. So what he's saying is if it fell through those lows, he's just going to ignore it, which we agree with him.
I think that's smart.
Yep. And then he's got to decide, well, at what point is he willing to buy it again, and then what's his rule going to be to sell it? So...
Yeah.
I mean, even a trend line might work well on that as it's rising, or one of our other rules, Trading Mentor.
I mean, I don't know. We don't know his rules and whether he's back-tested his rules and his strategy. If he has, then great. I have no problem with it. It's looking better. Yep. But I don't disagree with what he said.
Okay,
if that makes sense. I just wanted to make the point. I don't care what he did in the past. It's whether he knows what he's doing right now.
Yep, okay.
Because the past profits could have been a guess and just lucky. It may not have been good strategy or may not have been good technique. And so as long as he practices at this one, he could make some good money out of it.
I hope he does.
Yeah, all right, so let's move on. We do have an email. This one is from Alison, I believe, but it is a really interesting email and I really did like this one, so thank you for sending it through, Alison. She says, "Hi Dale and Janine, firstly a massive thank you for all you do in sharing your knowledge and experience." Now she says, "I read Dale's book and started watching your shows about 4 months ago, after I became concerned about how my now ex-financial advisor was managing my investments. Thanks to your advice, I stopped him executing a trade on my behalf after doing my own research. Had I followed his advice and done the trade, I'd have been down nearly 50% now in my position, as he doesn't use stop losses, and I learnt the trade was a gamble." She goes on to say, I've seen some media articles recently on artificial intelligence, doing technical analysis and analysing vast amounts of data to detect entry and exit points and forecast market movements. It seems at this stage it's mainly the big end of town that are using artificial intelligence and that the trades are mainly short term. What are your thoughts on the future of AI for trade alerts for us small individual traders? I'm thinking there will always be a need to do our own research once the AI software identifies stocks that are good entry or sell points. I hope this is not a silly question, but it has been on my mind for a while now, and I've finally found the courage to ask you. Thank you, Alison. Well, thank you, Alison, for having the courage, which is really good. Great question. It's not a silly question. It's a great one. I did a podcast the other day, which I think we may be releasing this week. It was on ChatGPT.
Yep.
And it was about my thoughts, because I have had journalists asking me about the same question. So, what do you think artificial intelligence? And look, I'm still quite sceptical, because I've had, even in the last 2 years, I've had 2 or 3 companies overseas approach me that have got artificial intelligence, picking stocks and blah, blah, blah. And I've yet to see one that's worth in its salt. But
I mean, it makes it sound fancy, but let's face it, it's just a program.
It's just a program.
That's using a whole lot of data, as she's saying, feeding it in there. And so from a technical person's point of view, I can understand that, because there are programs running everything. So why not the stock market?
Yeah, I agree with that. It makes sense.
The programs do run the stock market, but why not the buying and selling decisions. And over the years, we've looked at that with people. We've even, with Optima, the software, the people, the founder who's made that. I mean, people have said when they've used the software and they've tried to create the program, you've still got to have inputs.
Correct.
You've still got to try to work out. So you've still got to understand how stocks and markets move to be able to create those programs anyway. And a lot of the programs that historically were created were based on really, really short-term trading, which is what the banks do. So they're just taking a few cents here and there, in and out. And that's really not a way to trade. That's the way that they were trading to sort of minimise their risk because they were trading with such huge positions.
Well, they're basically scalping the market, aren't they? Which people can't do.
But there are programs that people can get that for individuals to use. But I've spoken to different people and basically they've compared it to doing technical analysis themselves, and they haven't been able to consistently get that to work over time. Something will eventually...
I've had the same thing.
So it's really not much different to a human looking at a chart, doing analysis themselves, but the difference is that you're disconnected. When it's a program that's got that information and somebody else has put it in, you've got no idea about all the inputs and how it works.
Still doesn't change human emotions, doesn't it?
And no idea how to fix it if it stops working.
Yeah, people will always second guess the program, whether it's accurate or not. And just to finish up, is I had a big long chat with the founder and of Optima about a year ago about this, because I had been approached by another company, and he said, Dale, I've done so much research into that and I've been approached by a lot of companies on it, and he said, I don't think it'll ever work properly as well as people who are trained by you and your team.
That's a big
that they'll be able to do better job than these programs. And because the end of the day is, you're the one buying and selling, not the program. You're the one pushing the button, and it's about you understanding what you're doing. If you're letting a computer do it, then it's flipping it over frequency. It may do it, but again, it's the big end of town don't like to lose money. So if individuals are using these programs, they're going to do something to stuff that up. Because if individuals are taking money from the big end of town, the big end of town are going to change what they do to make sure that they get the money back again. And that's exactly how the futures market works. It's the big end of town taking money from the individuals.
I mean, if you think about it, they still can't get the traffic to flow right.
No.
And that's with programs. So, how are they going to get the market to flow?
I know it can take me 50 minutes to go 3 kilometres to home from this place. So, geez. But anyway, I think we better finish up on that. But thank you very much for having the courage, as you said, to send an email. And you can be just like Alison and send us emails. And remember, info@wealthwithin.com.au, so send all that in. But now's the time for our topic for tonight, Janine, which is about Australia's big 4 banks and whether now is a good time to squirrel your cash away in a bank account to get access to the rising deposit interest rates, or are you far better off financially investing in bank shares?
Now, Dale, before we answer, it's no surprise to us when investors ask us that question, particularly as the RBA lifted the cash rate 9 consecutive times, and each time the banks have followed by increasing their lending rates. So you can understand the rhetoric of the media suggesting there is a risk of higher defaults on home loans. So do you think we need to be worried?
No. I'm about as worried as about Geelong losing the grand final on that one anyway. But Janine, okay.
It always has to be about footy.
It does have to be about, well, it is. I mean, the media, as we've pointed out so many times on this show, is the media like to sensationalising, and the truth is somewhere in the middle, or the other side of it, or the contrarian view is really where most of them, the truth really is, not necessarily what we're seeing in the media and the institutions, what they're pushing out, and they're just wanting to sell newspapers and get headlines. So I don't think it's as bad as what they're making out.
Thank you, Dale.
But we'll prove it, won't we? Like we always do.
Yep. Let's take a look at an article published by The Guardian. The article said that 800,000 households will fall off fixed rates mortgages to the more expensive variable rates this year, and it also mentioned that households on fixed rates of around 2% would see their rates rise to around 5.5% when they change to variable. So, should investors holding bank shares sell? For those investors who are on the verge of buying, change their view. What should they do?
Well, you're asking me whether they should change their view on investing in bank shares, get out of bank shares and go into cash. Is that exactly what you're asking me?
Well, I could ask you more, but yes, that's very close to what I'm asking you.
No, I wouldn't do that. I mean, interest rates are pretty normal, if that makes sense. To me, they're pretty normal. To you, anybody over 35, interest rates at the moment are pretty normal. Anybody probably under 35, they're not normal because, you know, the last 10 years we've had pretty much low interest rates, or a bit longer than that since the GFC. Interest rates went up and then they went down again. But I remember in 2007, I was paying more interest on my housing loan, and a pretty sizable one than today. Like, you know, and it was like, yeah, but it was fine. It was what we expected. Okay. You know what I mean? But that's all I've got to say.
Great.
I'll leave my more judgment till later on.
The Guardian also referred to research conducted by Roy Morgan. So let's take a look at the graph. Roy Morgan research estimates indicate that around 1/4 of mortgage holders are at risk of mortgage stress. Now, there is a danger of looking at this in isolation. Therefore, it is important to mention the long-term average is 22.8%. And if we look at what occurred during the GFC, mortgage stress rose to 35.6%. The graph also shows in red around 15% of borrowers who are considered extremely at risk. So I know that everyone at home can determine how serious they think the situation is.
Well, it's pretty... Geez, I mean, it's pretty obvious, isn't it, when you look at the graph? I mean, risk, those at risk versus those at extremely at risk really haven't changed much in percentage terms, in terms of, you know, if there's 100 people at risk and 10% of those are extreme risk, it's pretty much the same right across the board because you get that happening. It's just norm. It's like averages work out that way.
Well, there'll always be
yeah.
people in those two categories.
Absolutely.
It's just that when we saw the GFC, and that graph shows it, that it was heightened.
They heightened it, and they also have, and then they talk about mortgage stress and defaults on mortgage stress. I know with 100% certainty that if you have a house and you have a mortgage on it, you will sell everything you possibly can to keep that house. You will take on extra jobs, you'll do whatever.
And that's what the banks count on.
Banks know that with 100%. So borrowers who are in mortgage stress will do more to make sure that they keep paying their housing loans. I had personal friends that had 18% housing loans in the 90s.
Gee.
You know, and they had kids and stuff like that. So these people today have got it easy, if, in my book, and compared to that sort of stuff. So, but yeah.
And the banks make provisions as well. For
Well, they
all
do.
of that.
They crunch the numbers and they know what, you know, things are happening with wages and employment and the economy, and they look at all the percentages and that, and they just plan it all out.
And it's a very small percentage overall that actually defaults. So, look, I agree with you. There's no argument from me on this, unfortunately.
Geez, that's a surprise, isn't it?
Well, I'm going to ignore that. What's really interesting is an article in the Australian Financial Review last week that adds weight to this. The article mentions that Citi were expecting ANZ's December quarter update to include provisions for bad debts at around $130 million. But ANZ announced a much lower figure at around $83 million. Now, CBA will report tomorrow, so would you expect there to be a trend in the provisioning across the Big Four versus analyst expectations?
You've got to think that's going to happen, isn't it? I mean, you often find analysts overestimate.
Especially if there's been doom and gloom. I mean, they're going to be putting more of that. How can it not affect their decision making to an extent, or
well, it can't.
the weightings of things?
That's what I was about to say, but your brilliance beat me to it. It's when you're bombarded with so much negative, it's hard to be not affected by the negativity and be negative yourself. And I know that, I mean, both of us were trading through the GFC. Both of us had, were managing the portfolios and all that sort of stuff through the GFC, and we heard all this negative stuff. But how do you isolate that and do what you need to do for yourself that's the right choice? And, you know, the last 12 months of that, we've seen a huge amount of negative about the market, crashing, blah, blah, blah. But the last 4 or 5 months, it's always been, even longer than that, it's been interest rates. We've had 9 in a row, and we're still not up to where we were 10 years ago.
Exactly.
So really, what's the problem? Because the banks have been factoring 7% interest rates for well over 12 months. So therefore, any loans that have been happening in the last 12, probably 18 months.
And even higher than that now.
Yeah, and even higher than that, they would have been factoring repayments on 7%, not on what it was at the time. So we're talking about loans that were done 2 or 3 years ago, 4 years ago, where people probably overborrowed in the housing boom from emotions. And so they're in mortgage stress. But look, I think the figures you've shown, they're brilliant. And I think they just prove that, you know, yeah, I think it's more negative than the reality, if that makes sense.
Great.
So yeah.
All right. Now, I've followed the banks for a long time, and what I find interesting
Yep.
is...
What? You've been following the banks for a long time, Janine.
You know that.
That's not a surprise to me. Now, I do have to stop you there. Now, before we do get into our view on the banks, Janine, we need to say goodbye to sadly say goodbye to our YouTube viewers, so that if that's you, then you can still watch the whole 75-minute show by heading over to talkingwealth.com and subscribe to talkingwealth.com, as I mentioned. Now, as I mentioned earlier, it's just $3.54 a week for you to watch this show and our weekly stock market update, along with a wealth of knowledge from hundreds of interviews from leading experts on a range of topics, from investing, retirement, business, success, and the list just goes on. So for our YouTube videos, you can also still send us an email in for us to answer in next week's show. So just email info@wealthwithin.com.au, and we'd love to answer your questions next week.
For those watching on talkingwealth.com, then you will love what we have in the next part of the show, as we've more on the banks. We will share which ones you might want to buy. We'll also have lots more questions to answer and stocks to look at. So stay tuned, as we'll be right back after this short break.
For those of you been watching these reports, you'll know I've been chatting about the market more recently, or in January, about having 1 or 2 weeks down soon. And looks like last week was our first down week on our market. So will we get a second week or even a third week? And it's the lowest close that we've had since this week, which is the week ending the 20th of January. So at this point in time, I'd love to see at least one more down week. But as you can see, a very, very bullish January here. So I do expect February to drop back a little bit. But to me, it's really important now that we don't jump in and just start buying stocks simply because the stocks or the market is down a little bit. Really, it was all about how the market was going to unfold, not necessarily where the peak or where the trough was going to form. If it doesn't go down too much here and starts to move up, then the next rise is probably going to be nice and steep. That's really part of the area that I'm looking at, is how is the market going to unfold? Because you remember I talked about the left-hand side of the chart is history to us. We can't make money out of the history. All we can do is look at the right-hand side of the chart and make assumptions of how the market is going to unfold on that right-hand side of the chart. If it does go a little bit further down into this like 7.4 to that sort of area, then that wouldn't faze me at all. But this is great. You can look at this on a weekly basis and go, well, that's what happened last week. But 1 week really doesn't make an investment decision.